Hello. Today I'm going to be talking about one of the most talked about strategies, covered call. I say that is the worst strategy ever. Over next 10 odd minutes, I'm going to talk about why I say so. Risk disclosure, as always, equity investment is risky. Be careful. I cannot take any responsibilities for any financial success or loss. What is covered call? Covered call is when you have a long-term equity position of a stock, the same amount of stocks uh, calls you sell above the price at which it is getting traded. For example, right now Reliance is trading at about 1350. You sell 500 calls or one lot of Reliance at a for strike price of 1400 at 8 rupees. When you do that, you get 8 rupee. So if you keep doing it on a monthly basis, every month you will get between half percent to about 1.5%, and that's what you will be earning on an ongoing basis. What people talk about is it reduces risk of investment, it generates steady income, reduces cost of acquisition. For example, today I bought it for 1350, so this month I get 8 rupees, so Reliance price becomes 1342 for me. Next month again another 10 rupees, so 1332, and so on and so forth. We are eating time value, which is considered to be a very nice thing. Theta decay it is called. It is safe strategy as you are selling out of money call, which also gives space for Reliance to keep moving up. So from 1350 it can go all the way to 1400. Now let me look at another strategy, which is short put. Short put is you don't need to own any stock or anything, and you just sell the put in the money, which is again 1400 price of Reliance. You just sell the put. Surprisingly, this strategy gives you exactly same amount of time value. I'm going to cover some examples. And by the way, in option circle, selling naked option is considered very dangerous. And in the money option is the worst thing that you could ever do. Let's validate with some examples. Now here, what I've done is overlaid the first of all two strategies. So this the first one on the left hand side in the black box is the covered call strategy payoff diagram. If you look at it, it has got the blue line, and the same payoff diagram of the put. If you really look at it, it will give you exactly same picture. Let me talk the same thing in terms of numbers. So here, if I sell Reliance 1360 call, I am getting about 17 rupees and 65 paise, which is about 10 rupees away. If I sell the same put, I get 28 rupees, and this is in the money put. So 1360 minus 1350, which is 10 rupees, it has got the intrinsic value. So the time value is 18 rupees. So against the call time value of 1765, put has time value of 18. If you do the same thing for 1400 call, the time value is 8 rupees for the covered call, and put has got 59 minus 50, which is 9 rupees of time value, almost the same. You will see sometimes here and there, little bit here and there. Let's look at another example, SBI. If you look at it, SBI current price is 297.85 up there at the top. If I do 300 covered call, the time value is 6.65, and for the put it is 8.9 minus the difference of 2.15, which comes to 6.75, again almost the same. If I go for 310 call, which has got time value of 3.5 on the call side, and on the put side 15.440, minus 12.15, which is 3.25. Again, almost the same. How does the math work? So, if you look at time value, covered call and put, same returns, similar returns. Cost of trade. If I am doing covered call, I have already paid 100% for my equity investments. Against that same equity investment, I am going to be selling the call. So there is no extra investment for the call side. On the put side, I am going to be charged the margin, which is near about 20% of the cost of the equity at that point in time. So covered call is actually 5 times the cost. Brokerage, I am going to be paying a brokerage for equity buy and sell. On top of it, I am going to be paying brokerages for the call buy and sell. Here brokerage for put is going to be only once for the put, but the difference is not too much, because one, your STTs will be little higher on the put because you are going to be selling in the money, and you also are going to be making very less charges on the equity investment brokerages. So I'm not going to mark it as rate, but yes, that's a point to be considered. Tax implications. Everything that you earn from call is anyway 33% taxed for the upper bracket, 0% for long term equity. If you happen to sell equity in less than a year's time, you would pay 10%. I'm not considering that also. So it's near about the same. Put also will give you the similar things. What if the stock moves much more? Let's say Reliance 1350 goes to 1500. For both of them, I am capping my profit. I don't make any profit beyond 1400 and a little bit of premium that I have gathered. Let's say 8 rupees in this case. So if it goes beyond 1408, I would actually not be able to get all the benefits. What if stock goes down by a great extent? It's right now it is 1350. When I bought, I sold a call of 8 rupees. If it goes 1342, till then I am covered because my buying price has now become 1342. But what if it goes to 1300? What if it goes to 1200? What if it goes to 500? I have got unlimited loss. Same thing is also with the put, by the way. So now, put, which is considered to be not so good strategy, is coming out to be better strategy than the covered call. Food for thought, right? Do you really think that the cover call is the best strategy now? I don't think so. Better solution, when I buy a stock, I want to let it fly, let it keep on going. I have seen stocks going 10%, 15%, 20%, 30% in matter of months. Why do you want to put a cap on that? I'm buying stock because I believe it's gonna go up. So if I am going to be getting margin on my stock, there are multiple other different limited risk strategies that I can do. One of the option selling strategies is something that I have already put in onto the YouTube. You could look at that. If you liked my video, please click on like. Please subscribe to this channel to get more and more of trading and investing ideas. And thank you. Thanks a lot and happy trading.